Hey, this is Matt, and today we're going to look at how to find earnings opportunities in our Excel-based API. We're going to look in the core data tab of all the tabs in the sheet, and we're going to narrow it down by weeks to next earnings, look at some X earnings volatility data, look at our forecast. ORATS makes a forecast of future volatility. We want that in our favor when we're looking for over or undervalued situations, and we're looking at implied earnings. And then we'll filter these down and then copy the names into the value vol to take a closer look. So this might look a little complicated, but this is just an Excel based formula, and then what we're going to do is narrow down the field by using a formula today. So before I point you in this direction, I want to show you it's a little easier on the sheet itself. So again, we'll go to the core data. We'll get the earnings core and all. You could get general core or volatility info, but we're going to get the earnings core, and I already did that. And then we're going to get all, not a stock list. And then we're going to add a couple bits of information to our sheet here. We're going to add a filter, which I'm going to make sure that the weeks to next earnings equals, the earnings month, and the weeks to next earnings equals 1. Actually, you know what I'll do is I'll move that to the earnings month as 1. And copy that down. And then I will look for undervalued situations and overvalued situations by sorting this. So I'll sort from largest to smallest. So there are a couple undervalued, or there are 7 undervalued situations, and I'll sort this. There are 18 overvalued situations. All right, so let's look at what this formula is looking for. So in the PowerPoint, it has to pass the filter. It needs the absolute earnings move to be greater than the implied earnings move. So the absolute earnings move are what the stock has actually done on average, and what's implied in the market is the implied earnings move, and then I add 1 to it, so it has to be more than the implied earnings move, so that'll be a good signal. Our forecast earnings effect has to be greater than the implied earnings effect, plus 5. These are somewhat subjective, but has to do with how much those move. And I want the month 1 forecasted straddle price to be less than the month 1 actual straddle price, and then I need 20 cents of edge here. That's what that means. And then if that is all true, that's what the and means, then I'll get a 1, else I'll get a 0. And here's the actual formula that you could put in there. And so that's how I do undervalued and overvalued, just basically the opposite, but instead of plus, minuses. So let's go, now that we get these signals, let's go look a little bit more closely in the value vol. We'll copy these names in. So we'll look for undervalued situations first. So we have these names here are the names that we're going to copy into the value vol list, and then we'll update the list. Let's see how these look, and I'll sort this by the earnings. So we have Momo, SYY, VSLR. Let's try VSLR. We'll select the ticker and run the valuation. So as you can see, the earnings is in the front month. The earnings in the value vol are undervalued, and this could be a good opportunity. And you would do the same, just the opposite sign for the overvalued. So hopefully you enjoyed this, and contact me with any questions. Thanks.